99% of people who go broke investing are making this one major mistake. And it's not because they're stupid or they don't have enough information. In fact, this problem isn't even unique to retail investors like you and me. This is the same reason that massive banks have gone out of business over the last few months. And the problem is called a duration mismatch. Duration mismatch is when an investor's goals don't match the investment's timeline for profit. If you lock up your funds for 2 years, but you need that money in 6 months to run your business, that's a duration mismatch. If you're expecting an investment to profit over 10 years, but you need that money to pay your mortgage in 4 years, that's a duration mismatch. If you're Silicon Valley Bank and you buy 10-year bonds, but you have obligations to pay out your depositors today, that's a duration mismatch. And this misalignment can force investors to sell at the worst possible time. If you get wiped out as an investor, it's probably because you were forced to sell at a really bad time. And in the industry, that's called becoming a forced seller. And while duration mismatch is a major reason for becoming a forced seller, it's not the only reason that people become forced sellers. One of the most common ways to become a forced seller is by taking on leverage. There's a famous Warren Buffett quote. My partner Charlie says there is only 3 ways a smart person can go broke: liquor, ladies, and leverage. Now the truth is, the first 2 he just added because they start with L. It's leverage. Leveraged investing means using borrowed money or other people's money to create larger potential returns. So if you invest $1,000 and the investment goes up by 10%, you would have made an extra $100. But if you take out 10x leverage on the same investment and it goes up by 10%, you would make 100% more, or in this case, an extra $1,000. Now let's look at that exact same investment, except instead of it going up by 10%, this time it goes down by 10%. In the first case, with no leverage, you would have lost $100 and you'd be left with $900 of your original investment. But in the 10x leverage case, you would have lost 100% of your investment and have no money left at all. This is how the brainiacs at Long-Term Capital Management lost all their money back in 1998. Long-Term Capital Management had about $5 billion of real tangible assets that they owned outright. And then on top of that, they had around $125 billion of debt or other people's money. And when that debt position moved down by 4%, it totally wiped out the value of the real assets that they were holding. Because a 4% move on $125 billion is $5 billion. Today, some cryptocurrency exchanges offer 100 times leverage, so even a 1% move in your cryptocurrency overnight could wipe out your entire position. When you're taking on all this leverage, it's much more common to become a forced seller and end up being totally wiped out. Because even very small amounts of volatility, like a 1% move overnight, can be catastrophic for your leveraged position. So it's essential to be cautious with leverage and make sure that you understand all of the risks involved before you enter a leveraged position. Because even the super smart founders of Long-Term Capital Management couldn't get it right. For anyone who's unfamiliar, Long-Term Capital Management was a hedge fund that was started back in the 90s by 3 economists who went on to win the Nobel Prize in economics for creating the Black-Scholes model. If you want to learn more about long-term capital management and the risks of taking on all of this leverage, I suggest you check out the book When Genius Failed. I'll have a link to it down in the description, as well as a free trial of Audible, so if you do want to get the book for free and you haven't used Audible before, you can check that out for yourself. Also, let me know in the comments if you'd like to see video breakdowns of large financial collapses like long-term capital management, and maybe we can start a series here on the channel that does deep dives into why these different financial collapses happen. So now that we understand what common situations can make someone become a forced seller, let's talk about the practical steps that you can take to avoid these issues. First, you should think hard about the time horizon of every dollar you invest. And you can split up the duration for your different investments using a framework like this. Put money that you'll need in 1 month or super short duration money into a checking account. That's going to be your most liquid, most spendable money that you might need to pay bills and utilities over the course of the next month. Next, you can go ahead and put money that you're going to need over the next 2 to 12 months in some sort of high interest savings account. And that's going to act as your emergency fund. And sadly, given the state of like America and where we're at with all these banking collapses, if you're for some reason saving more than $250,000 of cash, you should really think about putting your money in like a systemically important bank, as crazy as that is to say. Because while they might not be giving you really any interest at all in the money that you're depositing, you can be pretty sure that like JP Morgan Chase is not going to disappear overnight in the same way that some of these smaller banks have. Next, you can put money that you're going to need for the next 1 to 10 years into a brokerage account so that it's paying you dividends in some sort of index fund while you wait to actually use that money. And then you can put money that you're not going to need for the next like 10 plus years into some sort of tax advantaged retirement account or some other form of long-term savings. Depending on your own risk tolerance, you can come up with these different time buckets for yourself. Maybe yours is 1 month and then 2 months to 3 years and then 3 years to 5 years and 5 years to 10 years. Everyone's buckets are going to be totally different, but as long as you go through this exercise of bucketing your money into different segments of time, you should be able to help yourself mitigate the risk of a duration mismatch. When you're being forced to sell assets from one bucket, maybe at a loss, at a time that you weren't expecting to have to sell those assets. That's really the ultimate thing that we want to avoid here. Creating this schedule and defining the assets within each bucket that you're going to be investing in is really going to force you to think about how much money you're going to need in each of those different buckets. And you can always rebalance those buckets on whatever schedule is best for you. And then as far as leverage goes, two of the most common forms of leverage in America are purchasing a home and then short selling stocks. So you should make sure when you go to buy a home that your debt to income ratio is somewhat reasonable, and you should make that calculation using pretty conservative numbers. Your debt to income ratio is basically your monthly debts divided by your monthly income. And a lot of popular mortgage calculators out there are going to try to get you to be below 35% debt to income. So for example, if you made $100,000 a year and you were paying $3,000 a month for all of your debts, including maybe your mortgage and your student loans and whatever else that you're obligated to pay, that's going to be about a 36% debt to income ratio, right? Because the $3,000 a month is obviously $36,000 a year. And 36% is right at that threshold where a lot of debt to income calculators are going to start yelling at you and suggesting that maybe you try to lower your debt to income ratio. Because again, what you're trying to avoid here is maybe your income takes a hit in the future, you get laid off or something like that, but you have this super nice expensive home that you think in 30 years is going to be worth more than you paid for it, but maybe over the short term, right now, you're underwater on the house. And so if you became a forced seller on that house, that would be really, really bad, especially because if you had just held that house to maturity over 30 years, you might have made money. This is pretty much the exact same situation that Silicon Valley Bank got itself into when it was holding these debt instruments that over 10 years would have made them money, but they never got to hold the instruments for 10 years because depositors wanted the money right away. As for leverage in the stock market, Warren Buffett's strategy has been to avoid stock market leverage. And if that's good enough for him, it's probably good enough for you and me. Other famous investors like Ray Dalio have made a lot of money trading with leverage in the bond and equity markets. But personally, for my mental health, I'd rather just own great assets for 30 years rather than worrying about, am I going to be liquidated overnight on my crazy leveraged position? So again, if you're going to use leverage, only do so if you fully understand all of the risks and understand at what price point you could get liquidated. Because ultimately, all of this is just to make sure that you don't have to go get rich twice. If you guys found this helpful, go down below and smash the like button for the YouTube algorithm, and check out this video over here to learn more about my thoughts on millennial retirement. That's it for today, guys. I love you all. See you next week.